Okay, so you guys have really thrown us a curveball with this one, with all this stuff about like annuities and perpetuities,
Yeah.
and even getting into like the nitty-gritty of how loan payments work.
Mm.
With all that amortization stuff.
Yeah.
It definitely sounds like something straight out of like a finance textbook.
Mm-hmm.
But our mission here at the Deep Dive is always to like cut through that jargon and really pull out the gems,
Exactly.
the stuff that can actually, make a difference in your financial life.
Yeah, we wanna make sure that people come away from this with like those aha moments,
Absolutely.
without getting bogged down in all the really technical details.
Exactly. Yeah. Like we don't want it to feel like you're back in school taking a test or something like that.
Yeah, for sure.
So, so maybe we should start by like just breaking down these concepts at like a super basic level.
Okay. Sounds good.
Like what exactly is an annuity anyway?
So at its core, an annuity is essentially a series of equal payments that happen at regular intervals over a specific period of time.
Okay, so like think of it like your paycheck hitting your bank account every month.
Ex-
Or like that rent check that you got to send out every month.
Precisely. Those are perfect examples of that consistent, recurring payment structure.
Okay, so that's annuities, but then
Yeah.
you also threw in this word perpetuities,
Right.
which sounds kind of similar but also maybe way more intense.
It is a bit more, well, let's just say it has a longer term perspective.
Okay. I'm intrigued. So tell me more about these perpetuities. What are we talking about here?
Okay, so imagine an annuity, but instead of lasting for a set period of time, it just keeps going forever.
Whoa, 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 hold on. Payments that never end.
You got a stream of equal payments, just like an annuity, but without an expiration date.
Okay, that's kind of blowing my mind right now.
It's a powerful concept, right?
Yeah, for sure.
Yeah.
But like where would you actually see something like that in the real world?
Well, there are a few key areas that the material highlights. One classic example is dividend-paying stocks.
Okay, right. I've heard of those.
Many companies, especially those that are well established, they aim to pay a consistent dividend to their shareholders every year.
Mm-hmm.
And theoretically, that could go on indefinitely.
Okay, so that's where the perpetuity idea comes in.
Exactly. And then you also have things like endowments and foundations, those that support universities or charities.
Right.
Those are often set up in a way to generate perpetual annual income.
So they can like keep funding their operations without having to touch the original money.
Precisely. And you even see it with some government bonds.
Really?
Yeah, some are designed with indefinite interest payments.
So that's a lot to wrap my head around, but I'm curious about the mechanics of it all. Like how can these payments just keep going forever?
It seems like the initial investment would have to run out eventually, right?
That's right.
That's the key insight here. The starting amount of money, the principal is meant to generate enough interest or returns each period to cover the payment.
Okay. Without ever dipping into the original principal.
So it's like living off the interest or earnings.
Precisely. It's like having a money machine that keeps refueling itself.
I like that analogy a lot.
The material gives this example of, let's say you have a financial instrument that pays out $500 every year, forever.
$500 a year forever.
That's the idea.
I mean, that sounds like a pretty sweet deal.
It definitely can be,
Yeah.
especially if you're looking for that consistent passive income without having to worry about reinvesting or the income suddenly stopping.
So perpetuities are like the ultimate long-term play.
You could say that they're about building that foundational level of financial security.
Okay, so we've got annuities, which are payments for a set time, and then perpetuities, which just keep going and going.
Right.
But now let's bring it back down to earth a bit and talk about something that I think most of us are a little too familiar with.
Oh, you mean loans?
Loans, exactly. And specifically, how we go about paying those loans off, which is where this whole loan amortization thing comes in. Yeah, amortization, it can sound a bit intimidating, but really it's just about understanding the process of how you pay down debt over time.
Okay, so like when you make your monthly mortgage payment or car payment, where does that money actually go?
Well, each payment you make, it's not just chipping away at the original amount you borrowed.
Right.
It's also covering the cost of borrowing that money, the interest.
Oh, okay, the interest.
Yeah, and the material explains that in those early stages of the loan, a bigger chunk of your payment is going towards covering the interest.
Because you still owe a lot of money.
Right, exactly, because interest is typically calculated as a percentage of that outstanding balance.
So the higher the balance, the more interest you're paying.
Right, but as you keep making those payments, the principal balance gradually goes down, and so a bigger and bigger portion of each payment starts going towards actually reducing the amount you borrowed.
Okay, so it's like a seesaw.
Yeah, kind of like that in the beginning, it's tilted towards interest, but then as you pay it down, the seesaw starts to balance out and more goes towards the principal.
Got it. So the key takeaway here is that understanding this whole amortization process can actually help you pay off your loan faster and save money on interest.
Exactly. And the material outlines some really effective strategies for doing just that.
Oh, tell me more, because I'm always looking for ways to save money.
Well, one powerful tactic is to make one extra full monthly payment every year.
Okay.
So instead of making 12 payments, you're essentially making 13.
Ah, I see.
And because that extra payment goes straight towards your principal, it helps to shorten the loan term, and you end up paying less interest overall.
So it's like a little bonus payment.
Exactly. And then another popular strategy is to switch to biweekly payments instead of monthly.
Biweekly, so like every 2 weeks.
Yep. You basically split your monthly payment in half and pay that amount every 2 weeks.
Okay.
And over a year, those 26 half payments actually add up to 13 full monthly payments.
So it's like sneaking in an extra payment.
Exactly. And that extra payment towards your principal really helps to speed up your payoff and save you money on interest.
Makes sense. And what about if you come into some extra cash, like from a bonus or something?
Oh, yeah. The material definitely emphasizes the impact of paying a lump sum towards your principal whenever you can.
Okay.
Whether it's from a work bonus, an inheritance, or even a tax refund, if you can put a good chunk of money towards reducing your principal, it makes a huge difference.
Yeah, like in their example of putting $5,000 towards a mortgage.
Right. It can significantly reduce the total amount you owe and even shave years off the loan.
So that's a big win for your wallet.
Absolutely.
Yeah.
So understanding loan amortization, it's not just about knowing where your monthly payment goes. It's about taking control of your debt and finding ways to pay it off smarter.
I like that. Pay it off smarter.
And the material also touches on why this is important for banks and investors, too.
Oh, yeah. Why is that?
Well, for lenders, amortization schedules give them a clear picture of their expected interest income over the entire life of the loan.
Okay.
It helps them with their financial forecasting and risk management.
So they can kind of predict how much money they'll be making and plan accordingly.
Exactly. It gives them a roadmap for their revenue streams.
Okay, so we've covered a lot of ground here today.
Yeah.
We talked about annuities, which are those steady income streams for a set period.
Right.
Then we explored perpetuities, which are payments that can potentially last forever.
Mm-hmm.
And we dove into loan amortization, which is all about understanding how we pay down debt and even finding ways to do it faster and cheaper.
Exactly. It's about taking those financial concepts and turning them into practical tools that can help you reach your goals.
Exactly.
Mm.
So as you think about your own financial situation, maybe you're looking to build a more secure retirement income.
Right.
Annuities could be something to look into. Or maybe the idea of generating passive income that keeps coming in for the long haul through things like dividend stocks.
Which operate on a perpetuity-like principle.
Exactly. That might be appealing. Or if you're currently dealing with loans, taking the time to really understand your amortization schedule could help you get out of debt faster.
And keep more of your hard-earned money.
Exactly. So we've given you a lot to think about today on this deep dive into annuities, perpetuities, and loan amortization.
I hope it's been helpful.
Me too. And I hope it sparks some ideas for our listeners as they navigate their own financial journeys. So as we wrap up here, I want to leave you with this question. Considering what we've talked about today, is there one area of your financial life where a deeper understanding of these concepts could make a real difference for your future?
It's a question worth pondering, for sure.
It is. Well, that's all the time we have for today. Thanks for joining us on the Deep Dive,
My pleasure.
and we'll catch you next time.
See ya.